What role does laissez-faire capitalism play in free market economics? If you're curious about how economies work and the role of government in them, you're probably wondering what laissez-faire capitalism is and how it fits into the broader picture of free market economics. Let's break it down. Laissez-faire capitalism is an economic system where the government has very little to no involvement in the economy. This means that individuals and businesses are free to operate as they see fit, guided solely by market forces like supply and demand. In a laissez-faire system, the market is self-regulating. This idea originated in the 18th century with the French physiocrats, who believed that economic success is hindered by government intervention. The term laissez-faire itself translates to let you do or leave alone, reflecting the belief that the economy works best when left to its own devices. In free market economics, laissez-faire capitalism plays a central role. Here, companies and resources are owned by private individuals or entities, and they are free to trade with each other without government interference. This lack of government regulation allows for maximum freedom in economic activities, including the production, allocation, and exchange of goods and services. One of the key principles of laissez-faire capitalism is the promotion of competition and innovation. Without government restrictions, businesses are driven to be as efficient as possible to stay competitive. This efficiency is supposed to lead to better products and services at lower prices, benefiting consumers. In a laissez-faire economy, the government's role is very limited. It is generally restricted to protecting national borders, safeguarding private property rights and personal freedom through law enforcement and the judiciary, and providing public goods that the market wouldn't produce on its own, such as parks and libraries. However, laissez-faire capitalism also has its drawbacks. Critics argue that it can lead to increased monopolies, greater social inequality, and market failures. For instance, without regulations, companies might engage in practices that harm the environment or exploit workers. Despite these challenges, laissez-faire capitalism remains a cornerstone of free market economics. It advocates for minimal government intervention, allowing the market to self-regulate and drive economic growth through individual freedom and competition. In real-world scenarios, no country operates under a pure laissez-faire system. Even in countries like the United States, which is often cited as a free market economy, there are still various government regulations and interventions. However, the principles of laissez-faire capitalism continue to influence economic policies and debates around the world. So to sum it up, laissez-faire capitalism is a fundamental part of free market economics, promoting economic freedom, competition, and innovation by minimizing government intervention in the economy. While it has its benefits and drawbacks, it remains a significant theory in understanding how economies can function with minimal government oversight.